Most people believe banks simply keep their money safe. You deposit your cash, it stays there, and you withdraw it when you need it. It feels simple. It feels secure. It feels straightforward. But what most people don't realize is this. Your money does not just sit inside a bank vault doing nothing. In reality, the moment you deposit your money, the bank starts using it. Banks are not storage companies. They are businesses. And like every business, they exist to make profit. The question is, how exactly do they make money using your money? To understand this, we need to start with the basic system of how banking works. When you deposit money into a bank account legally, that money is no longer physically yours. It becomes part of the bank's pool of funds. In exchange, the bank gives you a promise that you can withdraw that amount whenever you want. This is why your balance shows on the screen. It is not your physical cash sitting somewhere. It is a digital record that says the bank owes you that amount. That difference is very important, because once your money is deposited, the bank is allowed to use most of it, and this is where the real business begins. Banks make money mainly through something called the spread. The spread is the difference between interest they pay you and interest they earn from others. Let's break that down in simple terms. Suppose you deposit $1,000 into your account. The bank might pay you a very small interest, maybe 1% per year, or sometimes even less. Now the bank takes that same money and lends it to someone else. For example, someone taking a loan might pay 5% interest, 7% interest, or even more. So the bank pays you 1%, but earns 5% or more. That difference is profit. This is the core engine of banking. Banks collect money from depositors and lend it to borrowers. The borrowers pay higher interest than the bank pays depositors. The gap between those two rates becomes income for the bank. And they do this on a massive scale. Millions of deposits, millions of loans, millions of transactions. Even small differences in interest become huge profits when multiplied by millions of customers. But lending is not the only way banks make money. Another major source of profit is fees. Banks charge fees for many services: account maintenance fees, transfer fees, ATM fees, overdraft fees, card replacement fees, international transaction fees. Each individual fee might seem small, maybe $2, $5, or $10, but across millions of customers, those small fees add up to enormous revenue. There is another layer most people never think about. Banks also invest money. They do not keep all deposited money in cash form. They invest a portion into government bonds, financial markets, and other relatively stable instruments. These investments generate additional returns for the bank. Now you might be wondering something important. If banks lend out your money, what happens if everyone tries to withdraw their money at the same time? That situation is called a bank run. Banks know this risk exists, so they do not lend out 100% of deposits. Instead, they keep a percentage as reserves. This is called fractional reserve banking. It means banks only keep a fraction of deposits available in cash and lend out the rest. Why do they do this? Because in normal situations, not everyone withdraws money at the same time. People withdraw small amounts at different times for different reasons. That predictable behavior allows banks to use most deposits for lending and investment while keeping only a portion ready for withdrawals. This system has existed for centuries, and it is one of the reasons modern economies function. Now here is something interesting. Your deposited money actually helps create new money in the economy. When a bank lends money to someone, it does not always physically hand out existing cash. In many cases, the bank simply creates new digital money in the borrower's account. That means loans can expand the money supply. This is one of the hidden powers of banks. They do not just move money. They also help create it through lending. Of course, banks cannot do this freely without limits. They are regulated by financial authorities. Governments set rules about how much banks must keep in reserves, how much risk they can take, and how they must operate. These rules exist to protect customers and maintain stability in the financial system. Even with regulations, banks remain extremely profitable institutions. Why? Because their business model is built on leverage and scale. Leverage means they can use deposited money to generate much larger financial activity. Scale means they do this with millions of customers at once. When you combine leverage and scale, profits can become very large. There is also another way banks earn money using your cash: payment processing. Every time you swipe your card, send money, or make an online payment, there is often a small processing fee involved. Sometimes merchants pay it, sometimes customers pay it, sometimes both share it. These tiny transaction fees are another consistent income stream. And because people make transactions every day, this revenue is constant. Banks also earn money from partnerships. They partner with financial companies, credit providers, insurance firms, and investment services. When customers sign up for these services through the bank may receive commissions. So even if you think you are just using a simple bank account, the bank may still be earning from your activity in multiple ways. Let's summarize what we have learned so far. Banks make money from your cash by lending it to others at higher interest. They earn from fees, they invest deposits, they collect transaction charges, and they partner with other financial services. Your money is not idle. It is part of a system that constantly moves and generates value. Now, here's an important perspective. This does not mean banks are stealing your money. They are providing a service. They offer security, infrastructure, digital access, payment systems, fraud protection, and financial convenience. Running that infrastructure costs money. The profits they earn are the price of operating that system and maintaining their business. In other words, you are not just storing money. You are using a financial service platform. Understanding this changes how you see banks. Instead of thinking of them as storage vaults, you start seeing them as financial engines. And once you understand how that engine works, you become more financially aware. Financial awareness is powerful because when you understand how institutions use money, you can start thinking about how to use money yourself. The same principle applies at a personal level. Money can either sit or it can work. Banks make profit because they make money work. They move it, they lend it, they invest it, they circulate it. That is why financially successful individuals often focus on making their money productive rather than letting it stay idle. The lesson here is not to avoid banks. The lesson is to understand them. When you understand how systems work, you make smarter decisions. You choose better accounts. You pay fewer fees. You earn better returns. You avoid unnecessary costs. Knowledge gives you control, and control gives you financial confidence. So the next time you deposit money into a bank, remember this: your money is not sleeping, it is working. Not for you directly, but for the bank. And the more you understand that process, the more you can start learning how to make your own money work for you too. If you enjoyed this video and want more clear explanations about money, finance, and how financial systems really work, subscribe to this channel. This content is for educational purposes only and is not financial advice. Always do your own research before making financial decisions. Thank you for watching, and I will see you in the next video.